If you take a cursory glance at the financial headlines right now, you would be forgiven for thinking we are living through the single greatest economic miracle in human history. It feels less like a standard technological upgrade cycle, like the shift from 4G to 5G, and more like a religious awakening. From the overcrowded coffee shops of San Francisco to the high-frequency trading floors of Wall Street, the gospel is exactly the same. Artificial intelligence is here to save us all. It is being heralded as the fourth industrial revolution, a change as significant as the discovery of fire or electricity. The sentiment isn't just optimism, it's hysteria. We are seeing a level of collective buy-in that transcends borders, industries, and political divides. Everyone agrees this is the next big thing, and if you aren't on board, you are already obsolete. NVIDIA's stock has not just risen, it has defied every known law of financial gravity, adding trillions of dollars in market capitalization practically overnight. It has minted a new class of millionaires who simply happen to be holding the right stock at the right time. The charts don't look like normal growth curves, they look like rocket launches. We are talking about a company that was once known for making video game graphics cards, now holding the entire global economy on its shoulders. It is a gold rush where the shovels are made of silicon and the gold is purely digital. And just like in 1849, the people getting richest aren't the ones digging for gold, it's the ones selling the picks and shovels. NVIDIA is the standard bearer. CEOs of Fortune 500 companies are literally tripping over themselves to promise us a techno-utopia. They tell us seductive stories of a near future where AI cures all known diseases within years, writes flawless, complex code in seconds. Every interview involves a CEO claiming their AI strategy will revolutionize their industry. Whether it's selling burgers or building rockets, AI is presented as the magic ingredient. They speak in hyperboles, but behind these polished presentations and perfectly rehearsed keynotes lies a terrifying reality. These promises are checks that current technology might not be able to cash. They are selling a vision of 2050 using the technology of 2024. The narrative is flawless. It is intellectually seductive. It tells us of infinite growth, infinite potential, and infinite leisure. It is the story that desperate markets and tired workers want to believe. It appeals to our deepest desires, to do less and get more. It promises a world without drudgery, where machines do the thinking and humans reap the rewards. It is the ultimate capitalist dream realized through silicon. But narratives are often just that, stories. They are fairy tales for adults with brokerage accounts. And history teaches us that when a story sounds too good to be true, it usually is. And if you force yourself to look away from the flashing green stock tickers for just a moment, and instead, you dare to open the boring, dusty, unglamorous accounting books of these companies, you find a very different story. It is not a story of profit. It is not a story of efficiency. It is a horror story written in red ink. The balance sheets tell a tale of massive cash burn, unsustainable infrastructure costs, and razor-thin margins. While the stock price says trillion-dollar company, the cash flow statement says money pit. This disconnect is the first crack in the glass. It is the glitch in the matrix that nobody wants to acknowledge. Right now, as we speak, the most important AI company in the world isn't printing money, it's incinerating it. To be precise, multiple leaked financial reports indicate that OpenAI is burning through roughly $700,000 every single day. That represents solely the inference cost, the electricity and compute needed to generate text. It doesn't include salaries, rent, legal fees, or the billions needed for training runs. It is a staggering daily burn rate. Imagine a furnace where you shovel nearly $1 million every morning just to start the machine. That is the reality of large language models. They are computationally expensive beasts that require a constant sacrifice of capital. And that figure represents only the tip of the iceberg. When you factor in the astronomical costs of training new frontier models like GPT-5, poaching top engineering talent with multi-million-dollar salary packages, and acquiring rare hardware. Some top AI researchers are commanding salaries of $10 million a year purely because of scarcity. The war for talent is inflating costs across the board, and let's not forget the cost of data licensing. The losses for 2023 were estimated at a staggering $540 million. We are looking at a cost structure that is exponential, while revenue growth is linear. This is the definition of an unsustainable business model. And yet, despite bleeding $500 million in a single year, their valuation keeps climbing higher, defying all traditional business logic. We are looking at a company that loses money on every sale, but hopes to make it up in volume of hype. This creates a terrifying disconnect between the price investors are paying and the actual value the business generates. It's a discrepancy so massive that many seasoned economists are starting to whisper a word: bubble. But is it really a bubble? Or is this simply the expensive, necessary price of building the infrastructure of the future? Is this Amazon in 1998 losing money to build an empire? Or is it Pets.com burning cash on a business model that simply doesn't work? The difference between the two is often invisible until it's too late. To answer that question honestly, we have to look deeper. We have to ignore the press releases and look at a deadly indicator hiding in plain sight, an economic law that AI is currently breaking. It is a metric that predicted the dot-com crash. By the end of this video, you will know exactly what that indicator is. You will understand the fragile economics holding this entire industry up. We are going to dissect the anatomy of a crash before it happens. To understand why AI is bleeding cash so aggressively, we need to look under the hood of this machine. The engine of this revolution is not software, it is not code, and it is not data, it's silicon. Specifically, the NVIDIA H100 GPU. This chip has become the most valuable resource on the planet, arguably more critical to the modern economy right now than oil or gold. This isn't just a computer part, it is a marvel of engineering that borders on magic. Etched with nanometer precision by TSMC in Taiwan, it is the bottleneck of the entire AI ecosystem. This single piece of metal and silicon costs around $30,000. But the price isn't even the main problem, the availability is. You can't just walk into a Best Buy and pick one up. To train a serious large language model, companies like Meta, Google, and Microsoft aren't buying one or two. They are hoarding them by the hundreds of thousands. Mark Zuckerberg recently announced Meta is buying 350,000 of them. Do the math. That is over $10 billion in hardware alone, just for one company. It is effectively an arms race, a cold war of computation power. Every tech giant feels they need a stockpile of these chips, not necessarily because they have a use for them right now, but because they are terrified of running out. And in this war, NVIDIA is the only arms dealer in town. They have a virtual monopoly on the training hardware, controlling over 80% of the market, which allows them to dictate any price they want. Their Hopper architecture and CUDA software moat make it nearly impossible for competitors like AMD or Intel to catch up quickly. NVIDIA has effectively captured the entire value chain. This monopoly has created a brutal bottleneck that strangles innovation at the crib. Supply is artificially low, demand is effectively infinite, and prices are sky high. Startups are bleeding out just trying to rent access. We are witnessing a bizarre economic phenomenon where AI startups are raising $100 million in venture capital, only to hand 80% of it directly to NVIDIA the next day to buy compute credits. It is a massive wealth transfer from the innovators to the infrastructure providers. The startups take all the risk, trying to find a business model, while NVIDIA takes all the cash up front, guaranteed. It's the classic selling shovels in a gold rush strategy. But in this case, the shovels cost as much as the gold mine itself. It drains the ecosystem of liquidity, leaving very little money for actual product development. And unlike software, which you build once and sell forever, these chips depreciate faster than a used car. A simpler, faster, more efficient chip comes out next year, like the Blackwell B200. It is a treadmill of expenditure that never stops. To stay competitive, you have to keep buying the newest hardware, forcing companies to keep raising money just to stay in the same place. But the cost isn't just financial, it's physical. AI is incredibly thirsty. We tend to think of the cloud as something ethereal floating in the sky, but it is made of steel, copper, concrete, and vast amounts of water. A simple conversation with ChatGPT consumes roughly 500 milliliters of water just for cooling the servers. That's a bottle of water per chat. Generating a single image takes as much energy as fully charging your smartphone. When you scale this to billions of users asking trillions of questions, the energy requirements become unsustainable. We are essentially boiling the planet to generate memes and marketing emails. Data centers are already overwhelming power grids across the world. In Northern Virginia, the internet capital of the world, where 70% of global internet traffic flows, power companies have literally run out of juice to give. They cannot connect new data centers fast enough. Microsoft is so desperate they are signing deals to restart closed nuclear power plants like 3 Mile Island just to feed the AI beast. We are hitting the limits of physics. This massive infrastructure cost creates a barrier to entry we've never seen in tech. Unlike the app boom of 2008, where 2 kids in a garage could build a unicorn. As if the hardware crisis wasn't enough, there is another existential threat looming over the AI industry, one that could shut down the servers faster than any power outage: the law. For years, AI companies operated under the Silicon Valley philosophy of move fast and break things, scraping the entire internet without asking for permission. They acted like pirates, looting the digital library of humanity. They devoured copyrighted books, articles, art, code, and personal data to train their models. They assumed that fair use laws would protect them. But now the bill is coming due, and it's massive. The New York Times has sued OpenAI and Microsoft for billions. Artists are launching class action lawsuits. Major publishers are blocking their bots. The era of free data is over. We are entering the era of litigation. If the courts rule that training AI on copyrighted data is illegal, these models could be forced to be deleted or retrained from scratch using only licensed data, which would be astronomically expensive and technically crippling. Imagine building a skyscraper and then being told the land you built it on was stolen. You don't just pay a fine, you have to tear the building down brick by brick. This algorithmic disgorgement is the nuclear scenario. This legal uncertainty is a massive risk that isn't priced into the stock market. One bad ruling from the Supreme Court could wipe out half the value of the AI sector overnight. Investors are acting as if the legal battle is already won, but legal experts warn that this is the Napster moment for AI, just as Napster was shut down for copyright infringement despite being a revolutionary technology. The current iteration of generative AI sits on a legal foundation made of sand. And even if they win the lawsuits, they face a bigger, more fundamental problem. They are running out of data. Experts predict that by 2026, AI companies will have exhausted the entire stock of high-quality public text data on the internet. They have read every book, every article, every Reddit post, every line of Wikipedia. There is simply nothing left to read. This is hitting the data wall. To keep getting smarter, models need exponentially more data, but we aren't producing it fast enough. The internet is finite. We are reaching the point of diminishing returns, where feeding the model more data doesn't make it significantly smarter. It's like reading the same library twice. You don't learn much new the second time. The exponential curve of improvement that we've seen since GPT-2 is starting to flatten out, but the costs to train are still rising vertically. Some companies are even trying to train AI on data generated by other AI, which leads to a terrifying phenomenon called model collapse. It's like making a photocopy of a photocopy of a photocopy. Eventually, the image degrades into unreadable garbage. Research published in Nature shows that models trained on synthetic data start hallucinating, forgetting basic facts, and becoming unstable. They amplify their own biases and errors until they become useless. Without fresh, human-generated data, which is becoming harder to get as people lock their content behind paywalls, the exponential growth stops. The dream of an omniscient AI god hits the hard reality of limited resources. This means the promise of superintelligence, or artificial general intelligence, arriving next year is likely a lie. So, let's recap. The costs are astronomical, the energy is scarce, the legal risks are massive, and profits are non-existent. Why then is Wall Street still pouring billions into this? Why doesn't the math matter? The answer lies not in economics, but in human psychology, specifically a powerful cognitive bias known as irrational exuberance. It is a term coined by Alan Greenspan during the dot-com bubble. It describes how investor enthusiasm drives asset prices higher than any fundamental valuation can justify. Investors aren't betting on today's reality. They don't care about the P&L statement of 2024. They are betting on a hypothetical tomorrow where AI controls everything. It operates on the greater fool theory. I buy this overpriced stock not because I think it's fundamentally worth it, but because I believe I can sell it to a greater fool tomorrow for even more. It is a cynical game of speculation detached from reality. It's a game of musical chairs played with billions of dollars, and everyone is arrogant enough to think they will find a seat before the music stops. Nobody wants to look at the fundamentals because the fantasy is too profitable. To question the AI narrative today is to be labeled a Luddite or a pessimist. So the skepticism is silenced and the balloon keeps inflating. This reckless behavior is fueled by FOMO, fear of missing out. It's not just retail investors, it's the biggest CEOs in the world acting out of fear. Look at Google. For years, they were the undisputed leaders in AI research, DeepMind, but they kept it in the lab, prioritizing safety and reputation. When ChatGPT launched and took the world by storm, Google didn't see an opportunity. They saw an existential threat. They declared a corporate code red. They panicked. They didn't release their AI, Bard, now Gemini, because it was ready and tested. They released it because they were terrified of being left behind by Microsoft. Panic leads to reckless spending and bad products. It leads to hallucinations and demos and plummeting stock prices. Companies are desperately integrating AI into toothbrushes, toasters, and apps that don't need it, simply to say they have it. It's AI washing. We saw this exact pattern in the dot-com bubble. Back then, companies added .com to their name, and their stock tripled overnight. Today, companies mention AI as many times as possible in earnings calls. It is a mimetic contagion. CEOs see other CEOs doing it, so they do it too. It's herd mentality disguised as strategy. And when everyone runs in the same direction without looking at the cliff edge, disasters happen. But history teaches us a painful lesson. Bubbles eventually burst. Always. The laws of economics are like gravity. You can ignore them for a while with enough momentum, but eventually you fall. When the hype cycle moves from the peak of inflated expectations to the trough of disillusionment, the easy money vanishes instantly. And that brings us to the most dangerous problem facing AI right now, the utility gap. The hype says AI can do everything. It promises a universal assistant that solves all problems. The reality says AI is really good at a few things: coding, writing emails, and mediocre at most others. This cycle is not new. Railroads in the 1800s, radio in the 1920s, internet in the 1990s. Every revolutionary technology goes through a phase of massive overinvestment followed by a crash. The difference this time is the speed. The AI bubble has inflated faster than any before it, and the amounts of money are larger, which means the pop will be louder. We are currently sitting at the very peak of the roller coaster right before the drop. The view is nice, but the G-force is about to hit. Investors are starting to get nervous. You can see it in the volatility. One bad earnings report from Microsoft or Google, and the whole house of cards starts to shake. They know the music is about to stop. They are just trying to squeeze the last drop of profit before it does. It's a high-stakes game of chicken with the global economy. And the retail investors, people like you and me, are usually the ones left holding the bag when the institutions sell. The AI is the future narrative is starting to crack. People are realizing that artificial intelligence is often just statistics on steroids. It doesn't know anything. It predicts the next word. It's a parrot, not a prophet. And paying trillions of dollars for a parrot, no matter how eloquent, is a bad investment. When this realization hits the mainstream, the valuation multiple of these companies will collapse. We will go from magic to utility, and utility is priced much lower. But before we declare the end, we must look at the financials one last time, because there is one number that cannot be faked, spun, or hyped away. It is the ultimate truth teller in business, and for AI, this number is negative, deeply structurally negative. So we have the hype, the costs, and the legal threats. But can the business actually work? As the novelty of talking to a chatbot wears off, businesses are starting to ask the hard question: where is the return on investment? I spent $10 million integrating Copilot. Did my employees become $10 million more productive? And for many, the answer is silence. Wall Street analysts from Goldman Sachs and Sequoia Capital are starting to publish reports questioning the ROI of AI. They are asking, if we spend $600 billion on AI infrastructure, where is the $600 billion in revenue coming from? Right now, the revenue isn't there. We are building a highway system for a planet with 10 cars. Here is the uncomfortable truth no one wants to admit. For most businesses, AI is a nice-to-have, not a must-have. Yes, it can summarize emails, generate funny images, and write generic blog posts. But is that utility worth billions in infrastructure? Are companies actually making more money thanks to AI? Or are they just spending more on subscriptions to keep up with the trend? We are already seeing the first casualties of this reality check, the collapse of the wrapper startups. Thousands of companies raised millions of dollars with a pitch deck that was basically ChatGPT for X. They were just a thin interface over OpenAI's API. They had no unique tech, no proprietary data, no moat. They were just middlemen reselling electricity. Then OpenAI releases one update, or Google integrates a feature into Workspace, and their entire business model evaporates overnight. It's an extinction event for the middlemen. If your entire company is just a feature of someone else's product, you don't have a company. You have a temporary arbitrage opportunity, and that window is closing rapidly. Furthermore, reliability is a massive issue. Hallucinations where AI confidently lies make it risky for high-stakes industries like law, medicine, or engineering. You can't have a doctor that is right 90% of the time and makes up facts 10% of the time. That 10% is a deal breaker. This creates a ceiling for adoption. AI is stuck in the realm of creative assistant because we can't trust it with the keys to the kingdom until we solve the hallucination problem, which some experts say might be impossible. AI cannot replace the most expensive human labor, and if it can't replace expensive labor, it can't justify its expensive price tag. This brings us back to the deadly indicator I promised at the beginning, the metric that predicts the crash. It's called negative unit economics. In traditional software, adding a new user is magical because it costs almost nothing. You write the code once and copy-paste it a million times. It's infinite scalability with zero marginal cost. That's why software companies like Facebook or Google have gross margins of 80% or 90%. They are money-printing machines. But AI breaks this fundamental law of software economics. In AI, every query requires fresh, expensive computation. Every time a user types a prompt, a GPU has to spin up and burn energy. The cost doesn't disappear, it scales linearly with usage. If your cost per user doesn't drop as you scale, you don't have a tech company. You have a service company with massive overheads. And right now, AI looks a lot less like Google, high margin, and a lot more like a very expensive consultancy firm that loses money on every client. Unless the cost of compute drops by a factor of 100, the math simply doesn't work. The biggest risk isn't that AI will kill us, it's that AI will bankrupt us. The financial system is heavily leveraged on this bet. If the AI bubble bursts, it won't just hurt tech bros in San Francisco, it will drag down the S&P 500 pension funds and the global economy. The concentration of market value in the Magnificent Seven tech stocks means that if Nvidia sneezes, the world catches a cold. We have put all our economic eggs in one basket, and that basket is being carried by a robot that is currently hallucinating. So how does this story end? If we look closely at the data, history suggests there are two likely scenarios ahead. Scenario A is the hard landing. The VC funding dries up as interest rates stay high. The energy grid can't cope with the demand. We realize LLMs have hit a ceiling of intelligence and diminishing returns set in. The bubble pops, wiping out trillions of dollars in wealth, bankrupting thousands of startups, and leaving Nvidia with warehouses full of chips nobody can afford. It would be a market correction that could trigger a global recession, leaving a graveyard of servers in its wake. It would be 2000 all over again, but with higher stakes. Scenario B is the integration phase. The hype dies down, 90% of AI startups go bankrupt, but the giants, Microsoft, Google, Meta, absorb the technology. They integrate it quietly into everything, making it boring, invisible, but ultimately profitable over decades. Just like the internet became boring after the crash of 2001. It went from a new economy to just the economy. The excitement fades, but the utility remains. Microsoft is betting $13 billion on Scenario B. They are too big to fail. But for the rest of the market, it's a minefield. The technology is undoubtedly real. The revolution is happening, but the business model is currently broken. We are essentially building Ferraris to deliver pizzas. It works, sure, and it's impressive engineering, but it's simply not sustainable in the long run. Eventually, the bill comes due, and someone has to pay it. It might be the investors, it might be the consumers, or it might be the taxpayers. But the laws of economics cannot be suspended forever, not even for Silicon Valley. Now I turn the verdict over to you. I've presented the costs, the psychology, and the broken economics. Do you think we are months away from a massive crash like 2000? Or is this just the expensive price of progress? Let me know in the comments below. I read every single one. Your perspective matters because this isn't just about stocks. It's about our future. If you enjoyed this deep dive and want to support the channel, please hit the subscribe button and turn on notifications. It helps me create more documentaries like this. Thanks for watching, and see you in the next one.